Welcome to the first quarter market and economic update for 2026. In this video, we'll discuss what happened in markets during the quarter and what it means for long-term investors. After strong gains in 2025, markets faced a more challenging environment to start this year. A conflict in the Middle East, higher oil prices, and renewed economic uncertainty all weighed on investor sentiment. At the same time, many parts of the market held up well, and the principles of sound long-term investing continue to matter the most. Over the next few minutes, we'll walk through the key drivers of market performance this quarter and offer some perspective on what could come next. First, let's put the market pullback in perspective. The S&P 500 fell 4.3% in the first quarter on a total return basis. For some investors, that kind of decline can feel unsettling, especially after a strong 2025. But here's the important context. Pullbacks like this are a completely normal part of investing. Since 1980, the S&P 500 has experienced an average intra-year decline of around 15%, even in years when the markets finish higher. In fact, markets post positive returns in more than 2/3 of all years, despite experiencing multiple pullbacks along the way. Coincidentally, last year's first quarter also saw a 4.3% decline for the S&P 500, which was driven by tariff concerns at the time. And yet markets went on to finish 2025 with an 18% total return. Now, the past is never a guarantee of the future, so this is not a prediction for this year. Instead, it's a useful reminder that short-term volatility and long-term performance are two very different things. Next, let's talk about the biggest story of the quarter, which was geopolitics and oil prices. The conflict in the Middle East that began right at the end of February was the dominant market driver last quarter. Disruptions to the Strait of Hormuz, which carries roughly 20% of global oil supply, led to production cuts across the region. Brent crude ended the quarter at $118 per barrel, up over 94% year to date. Higher fuel costs affect consumers directly at the gas pump and indirectly through the prices of goods and services across the economy. The national average of price of gasoline reached $4 per gallon at the end of March. That said, economists tend to view these types of supply-driven price shocks as temporary. We saw this in 2022 when gas prices hit $5 before declining within months once the situation stabilized. And historically, geopolitical events, while creating short-term uncertainty, have not typically derailed markets over the long run. Investors who made dramatic changes to their portfolios in response to past events often did so at the wrong moment. Turning to the labor market, the economy has cooled from the pace of recent years, but it remains fundamentally healthy. February payrolls saw a decline of 92,000 jobs, and the unemployment rate edged up to 4.4%. Job seekers now outnumber job openings for the first time in several years. As recently as 2022, there were 2 job openings for every unemployed person, so this is a meaningful shift. That said, context matters here. Both the supply and demand sides of the labor market are cooling simultaneously, partly due to lower immigration and an aging workforce. The unemployment rate remains near historically strong levels, and consumer spending, which makes up more than 2/3 of the economy, has continued to hold up better than many expected. Let's turn to how different parts of the market have performed, because the headline index numbers don't tell the whole story. Even though overall indices are down, 6 of the 11 S&P 500 sectors are actually positive for the year. The energy sector has been the market leader, gaining nearly 40% through the end of March. Defensive areas like consumer staples, utilities, and industrials have also held up well. On the other hand, information technology has declined about 9%, and many of the large mega-cap technology stocks have underperformed. As this chart illustrates, sector leadership rotates frequently. Energy was also the top performing sector in 21 and 2022, before technology took over for the following 3 years. This is exactly why a well-balanced portfolio is so important. Predicting which sector will lead in any given year is extremely difficult, and a balanced approach helps weather different market environments. Finally, let's touch on trade policy, which took an unexpected turn last quarter. At the end of January, the Supreme Court ruled 6-3 that the broad tariffs were unlawful. The administration responded by shifting to a different legal authority and has also opened new trade investigations in recent months. For investors, the key takeaway is that the broader direction of trade policy will likely continue, and markets have shown that they can adapt. There will likely be more sources of uncertainty throughout the rest of this year, including a change in leadership at the Federal Reserve and the upcoming midterm election. The lessons from this first quarter and over the past several years to stay invested and focused on financial goals will hopefully help investors stay grounded through these events. We hope this quarterly update was helpful. If you'd like to discuss any of these themes or how your portfolio is positioned for what lies ahead, please don't hesitate to reach out. We look forward to speaking with you.